Welcome to Stock Option Counsel. I'm Mary Russell. I'm an attorney, and I counsel individuals on their stock options and other equity compensation. I often hear questions from people about startup valuation. You'll hear in the news that a startup is valued at some billions of dollars, and they want to know, what does that mean? Or they'll be negotiating for an offer with equity at a startup, and the company will tell them, oh, this company is worth $500 million. The question is, what does that mean? It's not a public company. It's not traded on Amex or New York Stock Exchange or NASDAQ. You can't just look up the most recent stock price per share. So what does that mean when we're talking about a startup's valuation? The most recent price per share paid by investors in the most recent financing, multiplied by the total number of shares outstanding after that financing closed, otherwise known as the fully diluted capital of the company, total number of shares that are outstanding and have been reserved. Price per share times number of shares equals startup valuation. So if you're joining a startup and they say, oh, the value is this, then I think the appropriate follow-up question would be, what was the post-money valuation, meaning after the investment valuation, in the most recent round of financing? Because we want to stay focused on facts, not focused on future value and what it's going to be worth in the future. That's interesting to hear what someone thinks their own company or baby is going to be worth, but it's a different question, or it's a different issue than what is the value of the company in the eyes of its investors. You see the difference? So that's something I see come up a lot, and there's a lot of confusion around. So I want people to have the right information so that they can discern the difference between a fact and what someone thinks their baby looks like. So I often hear questions about 409A valuation or common stock valuation and fair market value versus startup valuation. The startup's valuation is based on investor price per share. And there's a separate world of value that we use for common stock when it comes to employee and executive compensation. So you have at least two classes of stock in a well-organized startup with investors. One is the employee or the compensation class of stock, common stock, and the other is investor class of stock, usually preferred stock. And there needs to be a value set on the common stock for tax purposes, because options need to be granted at the fair market value of the common stock for which the options are created to purchase on the date of grant. But since those shares are not sold to investors for a certain price, there's no true value of those shares or way to set, for the IRS purposes, that value. So companies will go out and get an outside valuation firm to tell them, for tax purposes and purposes of setting the exercise price of the options, what is the value of the common stock. This is otherwise known as FMV, or fair market value, or 409 capital A value, which is a section of the tax code that governs employee stock options. And it's traditionally significantly less than the preferred stock or the investor value that the investors are paying per share. It's a totally different purpose, right? Investor shares, the company wants to sell as expensively as possible, as high a price as possible, to raise as much money with as little dilution as possible. So you see the difference? I hope that this is helpful. So when you hear startup valuation, you can think investor valuation, startup valuation, company valuation on one side, or 409A, fair market value, common stock, exercise price type value on the other side. It's two different things, two different purposes. I hope this is helpful for you. So again, I'm Mary Russell. I'm an attorney, and I counsel individuals on their equity. I'd be happy to hear from you at stockoptioncounsel.com. Thank you.